So today we're going to be talking about dividend investing and specifically about monthly dividends. The stocks I'm going to be talking about today are the ones that pay dividends consistently, that they increase dividends on a regular basis. These are recession proof stocks, and also a combination of all these stocks will give you a very well diversified portfolio which is going to be paying you dividends every single month. Hello everyone, my name is Alex. I hope you're doing well. I hope you're staying safe. Welcome to my channel where I talk about personal finance, investing, dividend investing, stock market, and what are the best ways to financially improve your life. Today we're going to be talking about dividend investing, specifically about monthly dividend stocks in Canada. So let's go. Stock market has ups and downs, which is totally normal. There is nothing out there that's constantly going up, except for Bitcoin. And the question is, how often do you want to check your investment portfolio? You probably shouldn't actually check it that often. If you're a dividend investor or a long-term investor like myself, you just put your money in and forget about it. And the other question is, what are we supposed to do when the stock market is experiencing a downturn, which is apparently what is happening right now. You probably saw that a lot of tech stocks just dropped 25 to 30%, which is crazy. And if you're investing in one of those, just keep holding, don't sell those. They'll probably rebound back. Who knows though. But the real thing I want to talk about today is how to make sure that your contributions to the stock market actually paid off on a regular basis. And that's where dividends actually come in, and specifically monthly paid dividends. So you get your dividends paid to you every single month, regardless what's happening on the stock market. And let's move on here and see what are the best stocks on a Canadian stock market that paid you dividends on a monthly basis. So the stocks I'm going to be talking about today are the ones that pay dividends consistently, that they increase dividends on a regular basis. These are recession proof stocks, and also a combination of all these stocks will give you a very well diversified portfolio which is going to be paying you dividends every single month. Isn't that great? All the stocks are from my own research and with consideration on several metrics. So what are those? So dividend yield, 4% and above. We want to get paid dividends, right? Not just hold the stocks. Payout ratio, ideally want to be less than 100%. It's hard to find companies like this, especially right now with this not stable stock market situation, but we're going to try our best. Medium to large company size. So I want to make sure that the company is not going anywhere. It's a recession-proof company, so it can survive whatever the market can throw at it. A beta parameter or our risk level. I want to make sure that the stocks that pays me dividends are not going to just deep all the way down. The next one is the 10-year share price growth. I want to make sure that the company is actually growing and the share price at least staying somewhere within its bounds or it's increasing over time. I know the company that pays dividends are not into a lot of market appreciation, but there are some that do. And the last point we're going to be looking at today is drip amount. So if you want to reinvest your dividends back to the stocks, we want to know how much we need to invest to get your dividends reinvested. So the first one is Pembina Pipeline Corporation. The ticker is PPL. And Pembina Pipeline is a leading midstream and transportation service provider in North America. The company is known for providing safe and cost-effective transportation services in the last 6 decades. It owns an extensive network of pipelines that transport crude oil, natural gas, and natural gas liquids produced primarily in Western Canada. The company owns a large number of assets consisting of pipelines and facilities that is super hard for newcomers to replicate. The company has 19 gas processing facilities and 6 billion cubic feet per day of net gas processing capacity. Pembina owns and operates an 18,000 kilometers pipelines with a total capacity of 3 billion barrels of oil equivalent per day. Pembina Pipeline Corporation has paid dividends since 1998 and has increased their dividends since the same time over the 4% over the last decade. Moreover, it's a low risk and its highly contracted business generates consistent cash flow that allows them to pay dividends. And now let's look at our metrics. So the first one is sector. So this one is in energy. Then the market cap is around $19.9 billion, which is great. The company is big and it's not going anywhere. Thumbs up. The dividend yield at 7.22%, which is great. We're going to be getting a lot of dividends from it every single month. The payout ratio a little bit high here is at 155%, which means that they're actually using some of their cash in order to sustain the dividend payments. The next one is share price growth. So over the last 10 years, the share price increased at about 60%. Then the risk level, our beta parameter, is at 1.72. So I would say it's pretty risky, 72% more risky than the average stock market, but I think it's still worth it. Now the DRIP amount. For this company, the DRIP is at $6,400. So if you invest $6,400 into Pembina Pipeline Corporation, you're gonna get enough dividends every single month to reinvest back to this stock automatically in order to get back another share of this company. Another point about Pembina Pipeline Corporation is that they're dividend aristocrat, which means that they increase their dividends over the last at least 5 years. And for them, it's been 9 years. So, which makes it a great investment, and it means that their dividend increase are probably not going anywhere, so that they continue to be part of the dividend aristocrat list. So I would say right now is one of the best companies to invest into, even regardless of how often the dividends are paid, just because the share price is pretty low right now, the dividend yield is pretty high, and you can also benefit from the share price increases, so it reaches the same price it used to be in February last year. Alright, let's move on to the next one, which is First National, and the ticker symbol is FN.TO. So First Financial is the mortgage company, and from the first look of it, you would think that it's not a great idea to invest in the mortgage company, right? Especially if you think that we are in a real estate bubble, which we probably are. The prices are pretty high right now, and it's just gonna explode and the whole thing is gonna crash. But the First National is actually an exception here. First National is an 8-year dividend aristocrat company. It has a very good yield, a reasonable payout ratio, and all of that despite what real estate market went through in 2020. The company has great capital growth potential. And unlike other companies on this list, First National is actually exposed to the recessions and market downturns, which is not great, but also it hasn't stopped them from paying dividends every single month and from increasing their dividends on a regular basis. And now let's take a look at our metrics. First National is in financial sector. The market cap is at $2.9 billion, which I would say is somewhere in the medium range. The yield right now is at 4.33%, which is pretty generous. The payout ratio is actually very reasonable, is at 63%, which means that they actually have some cash left over that they reinvest to themselves. Now looking at the 10-year share price growth, is it actually at 157%. So the company actually grew quite a bit in the last 10 years. Looking at our risk is at 1.34, so it's 34% more risky than the average stock market. I would say that is acceptable considering what we're getting in return. The DRIP amount is actually pretty high here, is at $13,600. So in order to get one share of First National with your dividend reinvestments, you need to invest $13,600, which is pretty high, so keep that in mind. Alright, let's move on to the next one, and it's Exchange Income Fund. The ticker symbol is EIF.TO. And this one is pretty interesting, and I consider this one of the best investments that you can make from all the lists that we have here. Let's take a look why. Exchange Income Fund is a diversified, acquisition-oriented corporation that focused on aerospace, aviation services, equipment, and manufacturing. The business plan of the company is to invest into profitable, well-established companies with strong cash flows operating in specialized markets. Exchange Income Fund is a very strong dividend aristocrats. They have a history of increasing their dividends for the last 9 years, which is crazy. And 2020 was a pretty rough year for them just because the industry they're in, air travel. And the company's side stock went down by 68% in 2020 market crash. Insane. And because the share price dropped significantly last year, the dividend yield went pretty high up. Let's take a look at our metrics. So the sector we're in here is industrials. The market cap of the company, $1.3 billion. The yield as of today is at 5.83%, which is pretty generous. Now payout ratio is actually at a very dangerous number right now, is at 292%, which is crazy. But hear me out here. The company has kept increasing their dividends through the worst payout ratios, and it was never a growth stock, and it might take a lot of time to recover. But the dividends will likely continue to grow, and they have a pretty strong balance sheet, which means that once we recover our air travel sector, their payout ratio will go back to the normal levels. The 10-year share price growth is at 61%, so there is some room for growth, And considering that the share price actually went down significantly last year and it hasn't recovered yet to the pre-market crash levels, we still have this room for growth. Now the risk and beta parameter is actually pretty high, is at 2.59, which means it's 159% more riskier. And the drip amount for this company is at $8,200. And considering their share price and the dividend yield and that the air travel sector has started to recover already slowly, I think we're in a good position here for both getting dividends every single month and also get some share price appreciation over the next year or two. Alright, let's move to the next one, which is Atrium Mortgage Investment Corp. And the ticker symbol is AI.to. They have a pretty cool ticker symbol, and it doesn't mean in any way that they're in artificial intelligence. They're actually in mortgage solutions. This company right now scored 10 out of 10 for most of our metrics here. Atrium is a non-banker lender, which allows them to furnish loans and mortgages for properties and projects which are not covered by traditional lenders and banks. And it also allows them to charge premiums on those. The company assets almost double their liabilities, and its operating income grows steadily. Let's take a look at our metrics now. So they're in financial sector. Their market cap is at $540 million. So it's not super large company, and I would say it's somewhere in the lower rank of those. The yield is very generous. It's at 7.05%, which is great for us. The payout ratio is also within our limits, which is at 96%. So the company is actually generating enough earnings in order to sustain a really good payout ratio. The 10-year share price growth is actually very interesting. If you don't consider the market crash of 2020, their share price growth was on a very good upward trajectory. During the 2020 market crash, the company tanked by around 65%, which is crazy. But they're already starting to recover, and they halfway through their recovery, which means there's still room for them to go back to the pre-crash levels. The beta parameter for them is at 1.15, which means that they're 15% more risky than average, and this is great considering what we are getting in return. The drip amount for them is actually pretty low, is at $2,300 right now, which is a great starting point for all the dividend investors if you want to establish your automatic reinvestments. Now let's take a look at a couple real estate companies that I think are one of the best ones right now in the market to get your dividends from. And the first one is Smart Centers, and the ticker symbol is SRU-UN.TO. What this one is about is if you ever shopped at Walmart, you've probably been on their properties. About 1/4 of the Walmarts in Canada are staying on the Smart Center properties. This REIT focuses primarily on retail properties. That's why it was hit quite hard during the last year market crash. The company has a powerful liquidity position and a robust balance sheet. And as I said, despite all the problems with the real estate and retail properties over the last year, Smart Center actually could maintain an occupancy of 97.8%. And the bulk of its tenants is actually one of the biggest companies out there, like Walmart, Loblaws, Shoppers, etc. And I would say Smart Center is actually not a great growth stock, but their dividend is pretty generous, and they're a dividend aristocrat as well, so keep increasing their dividends for the last 6 years. I still view Smart Centers is one of the smartest and actually cheapest way to get your dividends back, and also considering all the economy is getting back to normal very, very soon, I think you can also get your appreciation from the share price, and Smart Centers I think would still recover back to their normal levels of $30 per share sometime by the end of this year. And let's summarize all this into our metrics. So the sector we're in here is real estate. The market cap is at $4.4 billion. The dividend yield is at 7.13%, which is great and super generous. We're going to get a lot of dividends back. The payout ratio right now is not in their best numbers, is at 418%. So meaning that they're burning through cash in order to give these dividends back to their shareholders. The 10-year share price growth is actually at 0% because it's been pretty much flat for the last 10 years if you not consider the market crash of last year. But that's what I think makes this investment a great investment, because right now the share price is around 40% lower than it used to be before the market crash of last year. So there is still some room for recovery for this company. Our beta parameter is at 1.21, which is reasonable and makes sense considering what this company is doing and what the situation they're in right now. The drip amount is actually pretty cool right now as well. It's at $4,400. So you basically can invest all of your TFSA room and still get some change back and get your dividends reinvested. The next REIT we're going to be talking about today is one of the biggest one in Canada, which is RioCan. And the ticker symbol is REI-UM.TO. And RioCan is one of the largest REITs in Canada that focuses on retail and mixed properties. Around 90% of their properties are from retail, which explains why they were hit pretty hard during the last year market crash. And that was one of the reasons why they cut their dividend in December last year. So the sector we're in here again is real estate. The market cap of the company is around $6 billion, and the dividend yield is at 5.04%, and that's primarily because the dividend itself was cut in December last year. There's no information on what the payout ratio is for RioCan. And the share price growth of the last 10 years is also not great for RioCan. It's pretty much flat, but because the share price is lower comparing to what it was before the market crash, right now you can benefit from the market appreciation until it comes back to its pre-market crash levels. And our beta parameter here is at 1.17, which is within our limits. It's actually pretty good considering what we're getting in return. The drip amount for RioCan is at $4,600, and I would say that's pretty low considering all the other options in our list today. So I would consider RioCan is one of the riskier options from all the other stocks we went through today, just because the stock might take time to recover, also because they cut their dividend in December, but I think it will come back sooner than later once the economy is coming back to normal. But I really wanted you to make sure you make your own decision here, so keep all of these numbers in mind. And the last one for today is the Northland Power. The ticker symbol is NPI. So I left this one behind until the very end for a couple of reasons. So Northland Power is the power producer that develops, builds, owns, and operates clean and green power energy across Canada, Europe, and other markets. And being one of the first independent Canadian power producers, Northland Power has global operating facilities generating 2.6 gigawatts of electricity, with an additional 130 megawatts of facilities under construction right now, and more than 1,100 megawatts in project planning. And Northland Power has in-house development, plan designs, financing, and operation capabilities. It is quickly becoming one of the world's largest developers of wind farms. And as the world continues to demand more and more of green power energy, Northland Power will continue to expand and will see more opportunities for themselves in the future. And now let's take a look what it's all about. What is our metrics for this? So the sector we're here is utilities. The market cap for this company is at $8.48 billion. So it's pretty large and it's growing consistently year over year. The dividend yield here is pretty low compared to all the other stocks in our list today, is at 2.86%, but I think it's trending upward considering all the projects that are lined up right now for the company. They have a pretty reasonable sustainable payout ratio, is at 68%. Now the share price growth. So over the last 10 years, the share price grew at 162%. So that's incredible, and it keeps climbing up. So it's a great growth stock, and it also pays monthly dividends back. And the better parameter for Northland is actually pretty good here as well, is at 0.49. The one thing to know here is that if you want to stop your automatic reinvestments, the DRIP amount is actually pretty high. It's at $17,600. That is pretty high, and I don't have that money to invest in right now to get my reinvestments. But if you continue investing in this company, at some point you will get there and you will start reinvesting back. So this company is outside of our metrics for some of the parameters, but I think it's a great long-term solution, long-term vision stock that you need to consider. And so now to sum all this up, let's see what we get. If you create an equally weighted portfolio from all the stock that were listed today, you'll get a dividend yield of around 5.6%, which is great. It will give you sustainable monthly dividends back that you consider as a passive income, or you can reinvest that back on your portfolio. Depends on your needs. And this is enough for you to start a sizable passive income that you can rely on every single month. And with all the dividend aristocrats on the list, you can expect that most of your dividends are going to be increased consistently year over year. And that's it for today. Thank you very much for joining me here. Thank you for being here. And like, subscribe, hit the bell, and I'll see you in my next video. Thank you very much. Bye.